Namaskar viewers, hello and welcome to Sansad TV. I am Tina Jha, you're watching Perspective. US President Joe Biden has assured the American people and businesses that a resolution of the collapse of the Silicon Valley Bank will not put taxpayers' money at risk and that they can have confidence that their bank deposits would be there when they need it. Further, the Biden administration has announced that depositors of the failed Silicon Valley Bank will have access to their money starting Monday. A joint statement from the US Treasury, Fed Reserve and Federal Deposit Insurance Corporation on Sunday stated that depositors will have access to all of their money. The California-based Silicon Valley Bank, the 16th largest bank in the United States, was closed on Friday by the California Department of Financial Protection and Innovation, which later appointed the FDIC as its receiver. Started in 1983 in Santa Clara, California, SVB, as it's called, was deeply entrenched in the tech startup ecosystem and the default bank for many high-flying startups. As its name implies, it largely served technology startup companies, also venture capital firms, and well-paid tech workers. Now, its abrupt fall has marked one of the largest bank failures since the 2008 global financial crisis, sending jitters across the tech and banking sectors. The fallout of the crisis, its impact on the startup system, how the world equity markets are feeling the heat of the SVB collapse. All this and much more in Perspective today with three eminent guests joining us on the program. I'm pleased to welcome on this edition of Perspective Dr. Charan Singh, CEO, EGROW Foundation, Mr. Alexander Slatter, Deputy Managing Director, US-India Business Council, and Mr. A.K. Bhattacharya, Editorial Director, Business Standard. Thank you, gentlemen, for joining us on the program. Mr. Slatter, let me begin the program today with you. First, to put into context what the crisis is all about, how it began, and for our viewers to easily understand what actually led to this crisis. So if you could start the discussion.
Thanks so much, Tina. It's great to be here with Charan and Ashok. I really appreciate it. So, look, I think we have to sort of go back to the long period of low interest rates that the world, in fact, has experienced. I mean, you could make this go back 50 years where in developed markets, at least, there's been a trend of steadily declining interest rates for decades. And people sort of got used to that. And I think especially very recently in the last, since the Great Recession, where the Fed Reserve has kept interest rates low in an attempt to meet the 2% inflation threshold. And suddenly, with the multiple shocks coming from the global pandemic, the supply chain crisis, and then Russia's invasion of Ukraine, we saw inflation go into overdrive in developed markets. And even in emerging markets, it's gone up. And so you had the Fed begin to increase interest rates, and that set off a chain of rising rates around the world. But SVB was effectively running a rate arbitrage strategy, where they were providing very little interest on the deposits of their customers and investing in super safe long-term assets, U.S. Treasury bonds, 30 years, where the rates were as high as you could get when interest rates were low on a super safe security. So on the one hand, it wasn't a very risky strategy at all. But on the other, as soon as this wave of inflation hit and the Fed began raising rates, those long-term treasuries began to decline in price. And so that was to kind of maintain their return to investors. And so what that meant was that on the balance sheet of Silicon Valley Bank, its equity was being drawn down because they have to sort of balance the assets and the liabilities. And so ultimately, as these long-term assets repriced, they basically had an imbalance between the liabilities that they owed folks and the assets on their balance sheet. And when that went negative, that meant that the bank was insolvent, and the government has stepped in to make sure that some of the creditors of the institution, namely the depositors, will be made whole, and that their money is available to them today. The depositors are companies that are some of the greatest innovators.
So how reassuring is that going to be is something that we'll come back and discuss in just a moment. But Mr. Bhattacharya, what perhaps has sent jitters across banking sectors, across the tech startup system, as we've discussed earlier, is the abrupt manner in which this collapse has happened. Just last year, Forbes named Silicon Valley Bank as one of America's best banks. Moody's gave them an A rating. Now it's become the biggest bank failure since 2008, the second largest in US history. inflation, to contain inflation, and the interest rate hike could be possibly one of the big reasons. But how much is Donald Trump's deregulation bill also to blame? Senator Bernie Sanders is in fact saying that this is a direct fallout of the SVB crisis, is a direct fallout of what Donald Trump did.
Well, you couldn't be more correct on this. I think this is a clear case of regulatory failure to my mind, in the sense that if the bonds prices are being marked down, was there any scope for some sort of regulatory forbearance to make sure, because the banks were essentially doing well. There was no problem until there was a run on the bank. There was some concern over the bank depositors, and when they wanted to pull out the money, the banks were in trouble because they had to sell those bonds at a price which is less, and it's all because of in about 1 year's time, you saw the interest rates climb by almost 5 percentage points. So if the central bank, the regulator, has decided for good reasons to contain inflation, to raise the interest rates, so therefore the fallout of this on the banking system should have been part of the central bank's overall supervisory role. And I think the central bank's regulation is certainly was found lacking in this case. Now, its impact on the startup ecosystem is something that everybody knows, and I think even the Indian startup companies will not be fully spared.
So what kind of impact it's going to have on the Indian startups is something that we will discuss in just a bit. But let me bring in Professor Singh into the discussion as well. Professor Singh, apart from sending jitters across the tech sector, in the banking sector also, what's being spoken about is the contagion risk that this particular collapse could have. Do you see broader implications on the broader banking sector as well, on the broader banking system, not just in the US, but having a spillover effect across the world?
So there are multiple things that one needs to consider before reaching that conclusion. The first is, as you know, the Lehman Brothers was 3 times more than the balance sheet of the Silicon Valley Bank. That is one thing. But one has also to appreciate that the world economy is far more fragile and weak. It has just recovered. It has just come out of the ICU of COVID. And the whole economy, for the first time ever in 100 years, recorded a negative rate of growth. So the banking system only reflects what the whole economy is about. So while on the other hand, Lehman Brothers was 3 times more than SVB, but the economy is far more weaker this time. One has to keep that in mind. The other is, yes, this time the American administration has swung to action. They have said there will be no implication on the taxpayer, and I don't think that is true. That's not the way to interpret it. Any loss at the end of the day, taxpayer pays it. Now, the issue is how well networked SVB was with the other institutions, because that is where the contagion will begin. The second issue is there are about 10,000 depositors who are going to have an implication. They'll not be able to pay their employees, and about 1 lakh employees in the US are going to be directly impacted. As you know, the Silicon Valley Bank was financing heavily Indian American entrepreneurs and the startup culture. Obviously, that will have an impact on India also, because through remittances, we could be impacted. So the point that I'm trying to make is that yes, while others have said that contagion may not take place, my view is by tomorrow, about 48 hours after the market start and research happens, you will see that the real picture will start emerging as to how well networked SVB was, and then what are the implications it will have on others. The last point I want to make in this category is, you know that the Silicon Valley Bank went under because of the aggressive rise in the interest rates in the US. As you know, it was mainly the supply side, and they were using a sledgehammer to handle the demand side. I think there's lack of research on central banking and monetary policy. But then the issue is this interest rate hike that has taken place, which has brought SVB under, how many other institutions the same interest rate hike will bring under? So therefore, when my predecessor says there's an utter failure of regulation and supervision, I totally agree with that. But I also want to say the Basel norms, the mark to market value, those internal ratings and risks have not been taken care. And therefore, how many other institutions are going to get into this crisis? We will have to wait and see. That will unfold in the next few days. And
sure.
then
In fact,
we'll be able to say
let me get
how forceful
a perspective from Ms. Alicia Garcia Herrero. She joins us on the program as well on this pertinent point that you mentioned, Professor Singh. Ms. Alicia Garcia Herrero is a senior fellow at Bruegel and the chief economist for Asia Pacific at Natixis. Ms. Herrero, thank you for your time. Delighted to have you back with us on this edition of Perspective. What we were discussing just before you joined was the kind of implications that it is going to have, the contagion risk that the collapse of the SVB poses. Now, of course, there is an uncertainty because of the abrupt collapse of the SVB. And now there are concerns. Investors are questioning whether rising interest rates pose risk to banks elsewhere in the world. How serious do you think that risk is? And on the point of contagion risk also, how do you see that panning out in the days to come, as Professor Singh was pointing out?
Well, I actually think that it's unfortunate that a bank that is not really a bank, if you think about it, is basically making this breaking point that high interest rates really kill banks. I mean, to put it very, very bluntly. Actually, banks have made more money out of high rates, especially in Europe, than they've ever made for years. So in a way, the problem is not the level of interest rates. We still don't have a very high NPLs in the US, whether it's mortgages or anything else. I think the problem is the liquidity, the lack of liquidity. And it's more about the tech sector and the private equity market in the US than the rates themselves. I'm not arguing that the speed at which the US has lifted rates is not a problem for the global economy. I would say it's a problem for many other countries outside of the US as well. But I don't think this particular case of SVB is explained by rates. It's more of a fraud model that actually, in my opinion, should not be bailed out. And I think this is going to create additional moral hazard. Just to end on this point, the fact that every depositor, basically, as we speak, is going to receive the unsecured part of its deposit is going to put a lot of pressure on the FDIC for future potential defaults of banks that are real banks. So I think that the worst part here is the reaction, actually, of a bailout that I think will create humongous moral hazard for the U.S. in the face of the coming elections. Very difficult times.
You know, it's deeply impacted the Indian startup system, the Chinese startup ecosystem. That is something that we will discuss in just a bit in the next round. But do you see any spillover, any ripple effect of this crisis in Europe also, Ms. Herrero?
Well, we've heard that European banks are hardly exposed. So far, I think what we have had, which is quite important, is the UK, where we have had HSBC basically bailing out or buying at £1, basically the subsidiary of SVB. That's all we have. For the time being, nothing else.
Okay. Mr. Bhattacharya, so now coming to the impact that it is going to have on the Indian startup ecosystem. There's no doubt the collapse of the Silicon Valley Bank, which has been deeply entrenched in the tech startup ecosystem. It was a one-stop shop, in fact, for the tech visionaries. But if I go by the US-India Strategic and Partnership Forum research, it shows 70% of startups have immigrant co-founders, and just about number from the last year, 2022, shows over 50 CEOs of public companies are of Indian origin. What could be the timely and the most effective solution to address this crisis? And is there fear that if it is not addressed timely, it could snowball into a tech crisis as well?
Well, I would not say that there will be a tech crisis, but certainly if it is not contained in good time, it will prolong the winter of investable capital for the startup sector in India. Already, the startup companies in India are suffering from shortage of adequate capital, and now this is going to make it little worse. So, therefore, there is no doubt that the challenge for the Indian startup companies have only got more formidable.
Right.
Now, what can be done? I think there has to be an indigenous solution to a problem which India did not create. And I think there is need for the response from the domestic financial sector to come up with some sort of a funding instrument or a funding package by which the Indian startup ecospace, which was doing very well till recently, can access those funds a little more easily. Remember that till recently, Indian funding, startup funding, used to come also from China. Now that has come to an end for the last, at least for a year and a half. And many Indian startup companies were dependent hugely on the US investors. Now, if the US investor, the contagion does spread, I would say that there has to be an Indian solution to this problem by creating domestic funding bodies which can take charge and fill in the gap or the void that will be created.
Okay, Mr. Slatter, what are the immediate solutions that you see? Because over the last several years, there's been huge collaboration, convergence between the United States and India. And, in fact, this synergy is best epitomized by India's tech talent, the United States' robust tech sector. This crisis threatens that kind of convergence. So how do you see now solutions and timely and effective solutions, as I mentioned earlier, coming up from the United States administration to at least contain the crisis?
Tina, look, let me make a point quickly first. If you look at the statements of the regulators over the weekend in the United States and the Treasury Secretary, depositors at Silicon Valley Bank will have access to all of their money as of this morning. I'm not implementing this, I'm not running this, but I think that's a really important point. That means that no Indian tech startup, if they have an account with Silicon Valley Bank, will have their access to funds implicated. Not one company, okay? Again, I can't say that that's actually happening because I'm not the one withdrawing the money, but that's what that statement is meant to mean. In addition to that, you had Secretary Yellen talk about the measures that the multiple regulators in the United States are taking to ensure that there isn't a spread of contagion among American banks. That includes access to multiple funding windows from the Federal Reserve, acting as the lender of last resort, as it should in these circumstances, so that other banks can trade, do repos where they put their high-quality long-term treasuries, that similar to the assets that SVB had, with the Federal Reserve, so that they can get access to funds. That means that there should be no liquidity issues in the United States, okay? So everybody should realize that, and that means that, again, Indian startups shouldn't be adversely affected. I can't guarantee that right now in terms of access to deposits, but that's what this statement is meant to convey and should mean. In terms of contagion, look, I don't know who owns the bonds of SVB. I also don't know who owns the equity of SVB, but the people of the institutions that hold those entities will surely be negatively affected, right? But again, depositors, the companies that make payroll, that invest, that pay their bills, their suppliers, they should not have any access to their cash affected. That's the key thing here. And this is what we called for at the U.S. Chamber of Commerce over the weekend for prompt action by the U.S. authorities, and I'm happy that they did that. Now, in terms of how this is going to affect overseas funding by venture capitalists and private equity funds in the United States and here in India, I would expect that it's very important for Indian officials to continue to emphasize the strong growth environment that you have here, the innovation you have here, the strong human capital that you have here. And these regulators focus on paying attention to that sector, making a friendly face for venture capital and private equity investment to support their startups. But Indian officials are going to need to get out and say this to these investors because they're going to look at the global platform for investment opportunities even more closely than they had before this point. And, long-term or short-term treasuries at high rates of 5% are going to look even more attractive than they did before because they're very safe investments and far less interest rate sensitive than the 30 years, okay? So the key here is for India's growth story to continue to be sold and concrete steps to be able to show that that growth story is real, enduring, and that you have regulators here who want to make it a friendly environment for overseas investment and for the startup community.
Okay, but Professor Singh, looking at how things are panning out and the systemic risk that it also indicates towards, does it mean that the United States needs newer regulation, tougher rules for bigger banks to avert such crises in the future?
Obviously. Means just let me mention this to you. Remember 2004 we had the Global Trust Bank and there was a crisis brewing in the Global Trust Bank. And before Monday morning we had sold it to someone else. I understand America tried to do it. They couldn't find a suitor for that. So the Indian banking system, the regulator and the supervisor was always ready with option A, option B. In case something happens in the banking sector, they knew what exactly to do. Right now, 48 hours later, still statements are being made. We still do not know how much is the damage. Nobody is able to say what's the contingent going to be like. Arrangements. Yes, the Fed, the Treasury has made provisions. But what I'm trying to say is, as a regulator, as a supervisor, there is so much to learn from India. And that is why Joseph Stiglitz, the Nobel laureate, had clearly said, if Dr. Y.B. Reddy was the Fed chair, we wouldn't have had the Lehman. And I can say, 15 years after Lehman, you had the Dodd-Frank Act of 2010, you watered it down in 2018, and you have something now within 5 years. So and earlier the Glass-Steagall Act was removed. Glass-Steagall Act of 1933 had been diluted. And by 2007-8, you had the Lehman Brothers. So exactly what is going on in the biggest economy of the world, which has always taught us that there's a trade-off between regulation and innovation. Fine. But in a country like America, when such a failure happens, just imagine how it hurts the sentiments and confidence of the investors across the world. How do you repair that? So that is my worry. So I think America needs to revisit its regulatory and supervisory framework.
Okay, Ms. Herrero, as an economist, what kind of reforms do you think are needed in terms of the U.S. dealing with bigger banks to avert such, such crisis in the future? Because given the situation we've seen, it may not be as big as Lehman, but the vulnerabilities are still there, and it may happen in future if timely measures aren't taken. So this is going to have a spillover effect. By when is, of course, something that we will see in a matter of few days, that there will be solutions as well. Time is the key. But if we talk about the broader implications on the banking system, what kind of reforms do you think is the need of the hour when we talk about the U.S. system? Ms. Herrero, am I audible to you?
Yes, I'm here, yes. Well, I have to say something a little bit contrarian here about the U.S. I understand that the U.S. Has a trade-off that is different from Europe. In Europe, we've over-regulated banks. We have had negative interest rates. That doesn't help either, yeah? Where is the venture capital of the world in the U.S.? Where Indians, if not even Chinese, private equity funds getting their funding in the U.S. Now, can the U.S. cope with this situation? That's the key. We've learned over time is that, yes, it does. Maybe because it has the reserve currency of the world, maybe because, we can find many excuses why they managed to get out of these messy situations, but it so happens that they do, and they continue to have the center of the world of the financial sector. So my point here is that while I'm upset that they're bailing out these depositors, to be frank, simply because that's the way I've been educated and I've been involved in bank restructuring in countries in the world with the IMF, so it makes me upset. But at the end of the day, even a year from now, Indian venture capital manages to find its funding in the US, this will eventually be a success. That's the problem of it, is that it's a model that is self-destructing but self-creating. And I have to say that although I would be in favor of tighter regulation. I also worry that might, in a way, kill that dynamism, which is a dynamism that is not only for the US, but is basically for any risk taker in the world. And that's why we have to be balanced about, in other words, I can judge and say they should do more in terms of avoiding moral hazard. On the other hand, I know that if they do too much of that, will be killing the goose of the golden egg. So that's kind of the trade-off here. And I think we need to realize that.
That's right. In fact, I believe those are the kind of challenges that President Joe Biden may have to face in a divided Congress. He has indicated that the U.S. needs regulations and tighter rules, but by when can they come, whether they will be acceptable is something that we'll all have to wait and see. Time allows me to take up only that much on the program today. Thank you to all four of you for joining us on the program today, sharing your thoughts, your views with us and our viewers. It's always a pleasure to hear your views on the program. And to you viewers, thank you very much for your time as well. I'll see you same time tomorrow now. Take good care of yourselves. Keep watching Sunset TV.